The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Everybody, you know what that music means. It is time once again for Volatility Views, your weekly glance, your weekly deep dive into the world of volatility. My name is Mark Longo from the OptionsInsider.com and from the ever-expanding, ever-evolving Options Insider Radio Network. More on that a little bit later, but first off, let me introduce my boon companion, the yin to my yang, the degenerate premium buyer to my nonstop premium selling self, none other than Don Schlesinger from the Volatility Exchange. How about that, Don? Did I mess that up somewhere there? I'm not sure.
Once again, a degenerate. What can I tell you?
It wouldn't be a proper intro without that, sir. But yeah, it's going to be an interesting show today. Don and I are going to mix it up a little bit, and we have some interesting developments to share with you here on the Vol Views front. But first, let's dive right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and as you can tell already, longtime listeners, we're shaking things up already by changing the format around a little bit, and usually we'll do the Vol Review first. Today we're going to dive right into the Vol Viewpoint. This is the segment where we typically will have a guest, or sometimes just Don and I shoot the breeze about the world of volatility and volatility trading. We're going to do a little bit of the latter today because a lot of interesting things have happened over the past week that we want to hit on. Some from a volatility perspective and some from a more general options perspective that I'm sure you may have caught your eye, readers and listeners as well. And first up, I think the thing we really want to hit on first here is something that's just been lighting up my own personal tape all week ever since it hit the newsstand Sunday night. Listeners, you may have seen it. There was an article in the New York Times this weekend entitled "Growth in Options Trading Helps Brokers but Not Small Investors." It was a very interesting article, made a lot of, I think, very interesting assertions about options. It also kind of essentially condemned options as an investment vehicle for retail investors and kind of painted the brokerage firms as firms that are out there really just to squeeze the life's blood out of the retail, and they use options as a tool for doing that. Obviously, I think we've clearly laid out on this show and other shows on this network why that probably is not the case, but still an interesting topic to discuss, and to discuss from a volatility perspective. Now, Don, I know you have some interesting thoughts on this article as well. I think you and I actually differ on some of our viewpoints of this, so it should be an interesting conversation. But I'll give you pride of place first, so you can kind of espouse your thoughts first here for the readers for the listeners before I dive in.
I think I have a kind of a panoply of thoughts, so we may not disagree up and down the line. I read the article, and then I read the reply to it by the Options Industry Council, and I think there should have been a reply, and so we can talk a little bit about that as well. But for listeners who may not be familiar, just the study looked at some Dutch investors and, a very small sample, but the conclusion was that where retail investors were getting a particular return, options investors were getting a considerably smaller positive return, if any positive return at all. And so there was a kind of a blanket statement that said that, as you just intimated, options, I'm not going to paraphrase, but, you could imply or infer, if you will, options are a kind of a ripoff, or the public doesn't get a fair shake, or you can't invest in options and do as well as you can in stocks, etc. But, there are so many aspects to consider. So the retort or the reply from the Options Industry Council was that, you considered only options as a speculative tool. Probably someone goes out and buys a call because he thinks an index or a stock is going to do well, or somebody buys a put thinking the market's not going to do well. And of course, with options, we know that speculation is just one of many things that they can achieve. If you're looking for income, we know that writing calls against the stock portfolio has been shown to generate long-term income, and in some studies show that you could do even better than simply owning an outright portfolio of stocks. And we obviously know the insurance component, which is to own puts, sometimes in conjunction with a portfolio. And there, the idea is not necessarily to be making money with the investment, but rather to hedge, and therefore allocating a portion of your capital or your funds in order to protect and to have some sort of offset against the possibility of loss to the equity portfolio or whatever portfolio it might be that you're insuring. So OIC very correctly pointed out that the article wasn't looking at the entirety of the spectrum of what options are used for, but rather just a subset of that, where indeed, on a speculative nature, the aggregate public might not do all that well in terms of option investment. So that was the first point to be made. But I kind of had another point, and that is that the stock market can actually create wealth for the aggregate. The stock market is not what we call a zero-sum game, in that you don't have to have somebody who is short a stock for everybody who owns a stock. This is obvious to all of our listeners. But the options markets are different. Options markets are very much a zero-sum game, which means that at the end of the day, for every contract that is issued, an open contract and eventually closed, the sum total of all profits and losses adds up to zero. And as a result of that, you've got the entire population of people on all different desks, in all different guises, professional traders upstairs, professional floor traders, market makers, retail investors, portfolio managers, hedge fund managers, the entire universe of people who are using options. The sum of all of those profits and losses equals zero. So you obviously can have a bias towards which types of groups are in the aggregate making money and which types are losing money, which is not to say that it always has to be the same group. That would be a little depressing for the losing group. But the point is, there could certainly be, on balance or on average, one group or type of user of options who doesn't do as well in the long run and in aggregate compared to the other. And here I probably would suggest, and you'll tell me if you agree or not, that I think that in the aggregate, it's the people who do this for a living, the floor traders, the upstairs traders, the prop traders, who have books of options and who trade as a livelihood to make money, both for their firms or, for themselves eventually, who clearly must have the upper hand over the aggregate of, let us say, a retail investor. So in the sense that you can't have everybody winning all at once, I'd say that it probably is true that the general public as a group is somewhat at a disadvantage with respect to the professional traders. And somebody might say that that could also be said for individual stocks. But again, it's a little bit different here. People can invest in individual stocks through mutual funds with very low costs and practically, none whatsoever. And they can own a piece of equity without having to be experts in the kinds of trades or investments that, are out there. It's a little tougher with options. There's a learning curve. There's complexities of options. When you buy a stock, it's should I buy it or not? When you trade options, it's, should I do this bull spread or that one? What strikes? What maturities? Should I buy the front month? Should I buy the deferred month? Might I do this with a different volatility? There's a whole lot of nuances that make it a lot more challenging for the public than it is for, obviously, the professional trader. So those are a couple of the thoughts that I had while I read this article and the reply to it. And obviously, I'd be very interested in your thoughts as well.
It is an interesting one, and I've mulled it over quite a bit, and I've had a lot of people, contacting me for comment and questions about this article. I actually had a good dialogue back and forth with the author of the article, the reporter, actually. And unlike, we've seen a lot of these, quasi, I suppose you can call them anti-option screeds in a lot of the general financial media in the past. They seem to have gone away for the most part in a lot of the media. That's why I was surprised to see this pop up in the New York Times. That is, of course, the journal of record. So that gives this a lot of extra weight, particularly with that mainstream retail audience who may or may not be on the fence about options. And they read an article like this and they say, oh, well, thank God I didn't buy those calls in Apple or whatever the case may be. But, so the reporter, to his credit, was very open to contrary opinions and to some data I provided him, because I have several issues with the article. The first is he relies on some studies that I've never heard of, and I know a lot of the broad mainstream financial studies that deal with options. He pulled a study from the Netherlands that I don't know. Don, are you aware of that study? I've never heard of that study from 2007 that showed that essentially they claim that all retail options traders lose money. Have you seen that study before?
Doesn't actually roll off the lips as being
it doesn't.
The most famous one ever done, huh?
I guess a lot of the brokerage firms aren't beating that drum when they go out to get their clients. But yeah, so I need to really research that study a bit more. I'm not familiar with it. I've looked at some of their preliminary findings. One of the things I do want to do is bring those authors on this network to kind of discuss with them in a little bit more detail. I think obviously there might be some issues with their methodology that could impact those studies. Like, for example, are they counting hedging as a factor? I mean, if you're looking at a lot of options positions just squarely by themselves versus the underlying, if you're buying options to hedge, then yes, the options positions are going to lose money. But that's actually what you want to happen. So that means your underlying is at least staying stable or perhaps making money. So that's a desirable outcome. And if you're perhaps a less nuanced researcher, you just see, hey, all these puts are losing money, but the guys buying and holding stocks are making money. You're missing, I think, the bigger picture there. So there's a lot you could intuit from that. And he also talks to some academics from, I believe, Duke, who say the same thing. He says here, where is the quote? I don't want to take it out of context. But essentially, I'll have to find it here. But essentially, this academic from Duke goes on to say, yes, you can say, here he goes. He says, you can very clearly say in the aggregate that options don't help the individual investors' portfolios, which is, a very bizarre statement to make. The article also takes issues with a lot of the brokerage firms pushing options essentially to retail customers. He highlights, for example, E-Trade, and he says in the article, E-Trade's recent marketing material said, quote, every investor should learn how options trading could benefit them. And he highlights that as some sort of perhaps salacious or dubious thing for options firms to be doing or brokerage firms to be doing, when in fact I think that's exactly what they should be doing. That statement, I have no fault with that whatsoever. Every brokerage firm should tell their clients that you should learn how options trading could benefit you. That implies that you learn about options. That's a great thing. There are so many things that are just demonstrably false, I think, with this article. For example, Don, I see what you're saying about, the zero-sum game notion. Of course, we've talked in the past many times on this show about how hedging comes into play. And once you take hedging into consideration, all bets are off, because options are no longer a zero-sum game at that point. Two people could win from the same trade, two people could lose from the same trade, depending on how they hedge. So that takes things into a different ball game. But putting aside hedging even for a second, there are so many assertions here, like that the article essentially trumpets buy and hold as the preeminent investing tool. I think most people have seen that been disproven, except for Warren Buffett, who's the one outlier who continues to trumpet that. I think most people have kind of seen that just buying and holding over extended periods, you can do much better if you take a much more active approach. And options certainly facilitate that. And there are many ways that options can be used to improve your buy and hold, quote unquote, equity trading. For example, if you're a long equity trader, you should be using short puts to leg into long equity positions. That is demonstrably better than just working limit orders. I think you would agree with that, right, Don?
Yes, I believe that is true.
So that is a very simple step that every retail basic investor, if you're a basic retail stock trader and you're not writing puts to getting into equity positions, for the most part, you're doing something wrong. You're leaving a lot of money on the table. You're not being paid to work those limit orders. You're doing the same thing, but without any income stream. So that alone is the first step that all of these customers should be doing, and that is demonstrably proven to be true time and again. That is a better thing they should be doing. Then once you have a long equity position, you should be writing options against that. You should be writing covered calls to generate additional ancillary income to reduce some, I stress some, it's not really a risk mitigation tool, but it does reduce some of the downside risk in that portfolio, and in general improves overall returns. And that is another thing that is demonstrably simple to do that a lot of retail customers could do to demonstrably improve their returns. You get into other things that are perhaps a little bit more advanced, but still very easy for a lot of retail customers to do. And cover your ears for a second, Don, but you could come out and buy a put and then construct a collar. And then you have a hedged position that where the price of the insurance is reduced, if not all paid for, from the option that you're writing, and now you have a long stock position that is hedged, and that is a much better position from a risk management perspective than just buying and holding any equity. They bring up a point in the article that so many people flocked into options after the 07 and 08 meltdowns in the marketplace, and that they kind of highlight that as a bad thing, as if they're migrating to these very risky investments. I think the truth is actually the opposite. People were educated by that wipeout in their portfolios. They said, wow, I don't want to lose 30 to 40% again in a single calendar year. Maybe I should learn about hedging and buying these put things and put spreads and things like that. And so they started coming into options en masse. And that actually is a sign of retail customers becoming more educated and learning about things like risk management. That's a good thing. So that's something we should be trumpeting, not kind of denigrating as they do in this article. So there's a lot of approaches to take with this. But at the end of the day, I disagree with pretty much all of the fundamental assertions of this article. And you mentioned, Don, that you think you might agree with some of the assertions because you think a lot of the retail customers are buying options. And that, of course, plays into your long off-stated belief on this show that long premium is the road to ruin and destruction. Be that as it may, there are obviously pros and cons to all of that. But I think there is a case for that. There are people who are coming in and who are, let's say, less than savvy options traders. They want to trade XYZ underlying. They don't come in and buy an option with some meat on it, or perhaps do a vertical. Instead, they load up on 25 delta or 10 delta, even worse, out of the money calls and swing for the fences, and that all erodes to zero. They lose that money. They wash their hands of options. They're never going to trade them again. That certainly is a use case that unfolds on a regular basis. But they highlight TD Ameritrade in the article. They highlight OX in the article. These are firms with more sophisticated options clientele. And we do a lot, obviously, with a lot of those firms, including OX. And a lot of their clients actually fall into the active premium selling camp.
They're the more intelligent ones.
Yeah, exactly. So I think to highlight them as saying, oh, these options traders lose money, and then when they have a lot of premium sellers in there, I don't know if I necessarily buy into that assertion as well. Certainly things like Netflix and the dramatic movements that have happened in those underlyings have wiped out a lot of premium sellers. That certainly is the case. But to take that and extrapolate that and say, okay, this is clearly a reason now why options are not suitable for any retail investors. It's just, this whole thing just kind of leaves a bad taste in my mouth in terms of, this is kind of reminiscent to me of a lot of the older articles we used to see when the broader financial media wasn't as educated. They didn't understand the product, and they kind of just saw them in completely the wrong light. They saw them as risk additive tools as opposed to risk mitigating tools. I think my one clear issue with this article overall, letting aside the data and the other things like that, is that they don't differentiate in this article between proper and improper use of options. There's no clear distinction whatsoever. It's just use of options, that can mean anything. That could be the guy loading up on thousands of out-of-the-money puts, and that's clearly not a great use case of selling or buying. All right, listeners, and we are now joined in progress by our other co-host extraordinaire for this program, none other than good old Mark Sebastian from OptionPit.com. Mr. Sebastian, welcome back to this show of shows, sir.
Hey, thanks it's good to be here. Real good to be here.
And now Don and I, if you may have heard from the earlier part of the call, we're just discussing this somewhat inflammatory article that went up in the New York Times.
I mean, it was somebody with an axe to grind dealing with a reporter who has no idea what he or she was talking about. It's just silliness that I believe that study after study shows that options will reduce volatility and will over the long term improve performance. Shocker that a hedging strategy using options would underperform buying the market. And I think that when you write an article like that and you group everybody, not the educated option traders, into one thing, you also open up a whole can of worms. So what I would say is that was probably not a well thought out article by the New York Times, which is kind of their MO as of late anyway.
Well, leaving aside the New York Times stuff for a minute, but you're right. They had to go pretty far afield to find this quote unquote data and these studies they had showing.
Yeah, I don't know where they got it.
Yeah, there's a study from the Netherlands that no one's ever heard of, and some assistant professor at Duke.
You know what? There's probably something to it in that if you buy calls over time you lose, or if you buy puts over time you lose. But I don't think you can put the uneducated speculators in the same group. And they buy and hold. All right, so they're comparing buy and hold to option traders. That's like me comparing a minivan to a Tesla. It makes zero sense. So, and then saying minivan drivers are safer, or it's like saying give every average person in the world a Formula One race car, and they're going to get in more accidents than people in minivans. Congrats on the discovery.
That was kind of my assertion as well, that we were just getting into before you joined us here. Was that
silliest thing I've ever seen?
It is, and they really failed to differentiate, at least in my mind, between proper and improper use of options. They make it seem they lump all options together in one basket. They don't delineate at all between someone who's using options for hedging and income generation and things that are clearly and demonstrably beneficial to every retail investor, and they should be doing things like constructing collars, writing covered calls, buying protective puts, things like that, using short puts to leg into long equity positions. These are all things that all retail equity traders should be doing. And so to lump all that in with everything else, and who knows, we discussed earlier, who knows how they even take into account hedging. If you're looking at just options positions by themselves versus stock, of course, if you have long puts in one account and stock in the other that you're hedging with, one's going to do better than the other, but that's actually a good thing. That's what you want.
And to be fair, they did have a couple interesting points. They are right in that brokerage firms love options because they do produce commissions that are better than buy and hold. But I don't think there's anything nefarious to it the way the article kind of interpreted it. And they asked Steve Quirk, it's not like TD doesn't make efforts to try and educate people. I would say they're better than just about everybody in terms of trying to educate people about options. So, I think that it was really unfair. While they made some points, they were really unfair in a lot of ways.
Yeah, it was, and it was an interesting thing to see. And you're right, they hit a lot of the firms probably unfairly, because at the end of the day, obviously people want options customers. They're more desirable in just about every demographic. It's why the Options Insider is in business, because people want to come to us to get next to that options demographic. It's desirable. They're intelligent. They're educated. They trade more actively. They have larger accounts. Everything you want from a financial perspective, from a brokerage perspective, the options demographic provides. So it's clear that they would target those people. But of course, and certainly there probably is a salient point in there that some less than reputable educators and brokers over the years have taken a churn and burn type approach approach and selling people on the wrong types of strategies they shouldn't be implementing, like buying straddles and things like that, and then letting those people blow out and moving on to the next account. That's a difficult road to hoe as a broker, though, because the cost of acquiring a decent options account is so high. To think that brokers are just churning through these accounts intentionally is silly. That's a money losing strategy. You need to keep these guys. The longer you stay active as a brokerage customer account, the better it is for them. So they want you to stay in business. So that's probably the underlying underlying thing I disagree with the article.
There's so much that I disagree with there. I just think it was an irresponsible.
I know you missed it yesterday on the option block. I wanted to give you your chance to chime in here before we end the discussion. But yeah, an interesting thing certainly has been taking up a lot of my time this week responding to this in various formats. So wanted to give you guys a chance, and also our Vol Views listeners a chance to hear our thoughts on this article, because I'm sure a lot of you, and judging by our email and social media responses, a lot of you are up in arms about this artitle to various degrees.
It's just a ridiculous, poorly written, poorly thought out article, and and clearly written by someone who does not understand derivatives.
Don, last thoughts on the article before we wrap up the discussion here.
Well, again, it's not to be the devil's advocate, because I agree with the great majority of what both of you are saying. But I go back to my very original point, and that is there's a vast universe out there of users of options, and they fall into many different categories. And there's also a subset of that about how those different groups of people actually use options. And so it is clearly possible to home in on one particular subset, which might be retail customers who use options for speculation, and draw the conclusion that they don't do as well on a return basis as people who simply have a portfolio of stocks and a buy and hold and keep them on an ongoing basis. So if that's all that the article claimed or pretended to do, then the conclusion might be a valid one. We're all getting up in arms over the fact that the article didn't go further and wasn't more comprehensive and didn't talk about all the various virtues and benefits of options for risk mitigation, for income generation, for hedging, and what have you. And clearly we're right to bring all of that up, but it's hard to say whether the article was ignorant of all of these uses, or they would have gone further, or it simply wanted to bring up that one particular point, in which case Mark Sebastian is correct in saying, it's kind of not fair. Tell me about the minivan compared to the Ferrari. Well, it's obvious. We kind of know that already. So if you were writing this article to kind of just state the obvious, that in the aggregate, people who speculate and buy calls don't necessarily do so well in the long run, well, we're not sure you needed a 2-page article in the New York Times about that.
They could just listen to 2 years worth of Vol Views to learn about that, right, Don?
There you go.
Exactly.
All right, and now we're going to move on into our final segment, but a little bit different this time, a little bit different crystal ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball segment. And longtime listeners of this program know that this is the portion of the show where we usually look ahead to and make some predictions about what we're anticipating for the realm of volatility and volatility trading. But we're going to switch it up a little bit today and actually look ahead a bit to the future of Vol Views and what we have planned for you, the Vol Views listener. As I just jokingly referred to in the earlier segment, we have been doing this show for a while now, over 2 years. It started in March of 2011. Kind of hard to believe, Don, that show back at the Boca Courts was so long ago, but it was. So well over 2 years now. And as with anything, when you do it for this long, you want to maintain it and keep it exciting for us, the hosts, as well as for you, the listeners. And so for the latter category, it certainly has been delivering in spades. We've seen numbers for this show growing every month, which is fantastic, that the audience for volatility and for volatility trading continues to grow along with this show. And so now we're looking at some interesting ideas for perhaps refreshing the format of Vol Views and taking a little bit different take, if for no other reason than to help us, the hosts, keep a fresh handle on this show. So as we did last year, we're going to take a little bit of a hiatus for the summer, a shorter one probably this time, though. We're probably looking at taking the month of June or so off to step back and reformulate a little bit. But we hope to be back hopefully in July with the same old Vol Views you know and love, plus, I'll call it Vol Views Plus, because we're hoping to add some new voices, some new ideas, and perhaps some new segments and some other new topics and new discussion points that I think will really interest you, the listener. And of course, Mark will be back in all of his glory, helping us on the Vol Views program. So Mark, we look forward to you joining us again in our new and improved format in a month or so. Anything you'd like to leave our listeners with before we go on our short hiatus and return in a month or so?
Yeah, don't discount the increase in volume of Treasury note futures. I think that's pointing towards something. VIX and some of these other things aren't really reacting, but I think you have to pay attention to what's going on. I do, before we get any type of blow up or implosion one way or the other, you always see something changing. And I would say that certainly in the credit market, something is changing, and that's what should really be paid attention to.
Yes, if you're interested in the credit market and what's going on with the rates products, we did just do a great show with the CME, our episode of our long and short of futures options, where we dive specifically into the rates. That will be up on the radio network hopefully next week, so you, the listener, can check it out. We were there actually on Wednesday this week, or when we were there this week on the day when the Treasury futures exploded, so it was certainly opportune timing on our part to get into some of that stuff. Now, of course, as we're wrapping up here this final pre-hiatus show, I also want to turn it over to Don for you to give our listeners some final pre-hiatus, some pre-Vol Views Plus thoughts, Don, here as you look back on 2+ years and look forward to what we're going to be doing here with this new evolution of the program.
Well, it's been a wonderful run. I couldn't have enjoyed this experience more, and I hope that we will be continuing it, if perhaps in a slightly different format. This is actually, counting our preview shows, our 94th episode of Vol Views. And as you mentioned, when we first began back in March of 11, and I kind of wondered whether this was just a quick and temporary few shows or whatever. I really never dreamt that we would have built the growing audience that you alluded to. I've had an absolutely wonderful time with both you and Mark Sebastian. I really hope that we will continue that, perhaps even with a slightly altered format in July. So I obviously thank both of you for the wonderful opportunity that we had with Volex to be able to do the show. And of course, no such show is ever anything without the listeners. So they are due the great thank you for their ongoing interest, for the wonderful hundreds of questions that they wrote in and kept our mailbag section so stimulating, and for what I imagine was a good deal of praise, for which I thank you. Not 100% of all letters were positive, but the vast majority were. And we also thank you for constructive criticism and letting us know how we could make the show better. So nothing but positive thoughts. It's been a wonderful experience for me. And after we do take our little break, I hope that we will be able to continue our participation.
Yes, watching the evolution of the audience for this program has probably been the biggest surprise and the biggest joy for me of this program. When you, Don, and Don, when you and myself and Bob and Charlie all sat down to envision this program, I thought in the back of my mind, who is the target audience for this? And it was very much the hardcore institutional volatility trader. And I thought maybe couple of thousand people max in the country would even be equipped to process a show like this. Fast forward 2+ years, we've seen the explosion of interest in volatility and volatility-related products, and of course, along with that, and I think also had a little bit something to do with the fine program we were putting together here and the excellent roster of guests. No other show on my network has had anything close to the stable of guests we've had here. Nobel laureates, every options great you can think of has been on this show in some way, shape, or form. So it's been a fantastic stable of guests. And to watch that evolution over time and that explosive growth, and clearly a new category of listener coming into the volatility spectrum and coming into a show like this, the very high end of the retail echelon. People who are coming in through retail accounts and learning about volatility, whether they're trading products like FIX or trading straddles or trading VXX or whatever the case may be, they're becoming much more nuanced in the ways of volatility, and they're becoming equipped to listen to and understand and even enjoy a show like this. So we thank all of you listeners as well. And as we move into this new evolution of Volatility Views, don't worry, it's going to be the same old show you know and love, just a little bit better, calling it Vol Views Plus, and we're looking forward to it launching hopefully in a month or so once we get all the final details worked out, but it should be really, really exciting. So on behalf of Don and Mark and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success over the past 2+ years. And we'll see you again soon for our new incarnation of the Volatility Views program. See you then.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.